Record and share my screen. Give me 1 second. All right. Okay. Hi, everyone. Thank you for joining. I am Olivia. I'm a real estate agent with Good Neighbor Realty. And today we're going to be talking about the power of appreciation, investing, and how to build long-term wealth. So I'm a real estate agent and I have 2 short-term rentals, both in Arvada. They are both single-family homes. I also have a primary residence in Arvada, single-family home as well. And I invest for appreciation. So cash flow is great. If I can break even, great. But I'm in it for the long run. The appreciation, that's how you build wealth. Cash flow, in my opinion, is just a cherry on top. And that's kind of what I'm here to show you today. So today we'll talk about which areas in Colorado have the highest appreciation post-COVID, which asset types appreciate more quickly than others, and how appreciation builds wealth versus cash flow, and then the tools for the appreciation insights. So I will show you how I found out all this data and where you can go find it as well if you're interested in other markets or want to do some more digging into specifically what you're interested in investing in. So this is Colorado market trend for February 2025, comparing it to February of 2024. Sorry, it's a little blurry, but hopefully you can still read it. So on the left here is median sales price for the entire state of Colorado. So for all product types, meaning single-family homes, condos, and townhomes, we have seen a 2.4% appreciation. If you break out single-family homes and condos and townhomes, we'll see that the appreciation varies drastically. So for single-family homes have appreciated 3.6% since this time last year, whereas condos and townhomes have depreciated by 4.2%. So whenever you're looking at appreciation data, you should always try to filter down by asset type because it makes a big difference if you're looking at condos and townhomes versus single-family homes. Also keep in mind that Colorado is a big state. More than half of our state is very rural, and rural markets do not appreciate as quickly as the markets most of us are familiar with Denver Metro, the mountains, the foothills, that kind of thing. So a lot of the times the rural areas will lower the overall appreciation statewide. To put this into perspective, the 2024 appreciation versus 2023 for the entire United States was around 6%. So that's kind of how Colorado shakes out. And then I will break it down into, exact locations, the appreciation for exact locations in a future slide. So let's look at single-family homes versus condos a bit further back to see how it differs. So let's look at pre-COVID 2017 for the entire state of Colorado. So from 2017 until 2024, or I guess beginning of 2025, condos and townhomes have appreciated by 45%, whereas single-family homes have appreciated by 58%. Now looking at COVID time, 2020, we've seen 19% appreciation of condos since 2020 and 28% in single-family homes since 2020. Now, people think that Colorado has just been, some people think this, that it's just been, a post-COVID boom, but there was a ton of appreciation here in the 20 teens as well. Like you see from 2017 to 2020, there was like a 30% appreciation, nothing to do with COVID. And like even looking farther back, there's been high appreciation, since definitely before I moved here. So we've been a highly appreciating market for a very long time. And so have condos too, honestly, but they just don't appreciate, as quickly as single family homes, even looking back farther. So looking at post-COVID, the appreciation since 2023 for condos has actually been depreciation. They've gone down around 3%, whereas HOAs are always increasing, insurance is increasing, expenses are increasing, but your property value is decreasing since 2023, unfortunately. Whereas single family homes have gone up about 4.5% since 2023. So this just goes to show that single family homes in general in Colorado are a better appreciation play if you can afford a single family home. And it makes total sense because if you think about it, if you guys live in Colorado, if you look at all the new build and new construction that's going up anywhere you look, it's all condos, townhomes, row homes, just huge developments, barely any yard, barely any separation between your neighbors. So the demand or the supply for single family homes that have a yard that aren't in an HOA, they're not building any more of that. So it is supply constrained, but demand keeps growing. So naturally, prices will go up faster in those types of homes than any other asset class. So I've only been buying single family homes, no HOA, has a yard, good for a family, like that kind of thing. That's what I see, and that's what the data says will appreciate the most quickly in Colorado. So now I broke down the kind of most desirable counties and the counties that we work the most in that our investors are most interested in. So this is the median sales price from the change in median sales price from all of 2023 compared to all of 2024. So we can start with Boulder, and Boulder, this is Boulder County. And so Boulder County encompasses the city of Boulder, but also a lot of the foothill region, like Nederland and Allens Park and Lyons, like all of that Boulder foothills, that all is Boulder County. So they've been pretty flat for single family homes. If you look down the line of condos, pretty much all condos in every area has depreciated since 2023, besides Summit, which is just a modest 2%. And then Adams County, which is North Denver suburbs, so Westminster, North Glen, Thornton, I think that Thornton's Adams, that's all Adams County. They've been pretty flat as well. The foothills have seen modest appreciation since 2023. Eagle, which is where Vail and Beaver Creek are, again, modest appreciation. It's funny because the median sales price for Eagle appreciation is 2.6%, but if you look at the average sales price appreciation, it's like 16%. And that's just because the prices of the luxury homes that sold totally skewed the average like 16% higher than last year or than 2023. So just median price is more accurate, but there were some really expensive homes that sold in Eagle County in 2024. Jefferson County, which is the West Denver suburbs, Lakewood, Wheat Ridge, Golden, Arvada, we've seen just under 4% appreciation, and Denver has seen the highest appreciation of any other like metro county. And then Summit County is just like out of this world high appreciation. A lot of the people that buy in Summit County are buying in cash, and so they aren't affected by interest rates being high. They can afford to buy in cash in Summit, and there's not much space to build any single family homes. Just, yeah, there's no room to build, and everything that's going up in Summit is our condos as well. It's just more economical for developers to build. So if you want a good appreciation play, buy a single family home in Summit. They also do really well for short-term rentals as well, like Blue River area in Keystone. Definitely a really good place to buy if you have, $1.5 million plus budget, but the appreciation is unmatched compared to anything else. And then as far as questions, you guys can post them in the chat, or at the end I'll stop and you can raise your hand and we can get all your questions that way, but I'll get to those at the end. Okay, I get asked this all the time. Are we going to see a correction in Denver Metro, mountains, nationwide, all that good stuff. And I tell people we've already seen a correction and no one noticed. So if you look at, this is the Denver County appreciation or median sales price graph since 2020. Obviously, we saw a huge appreciation from 2020 to beginning of 2023. In the spring of 2022 was when the Fed started raising rates. And this is when end of 2022 is when it kind of peaked around like the 7.5, 8% range. And then prices just dropped after the rates peaked around there. And then I think people in 2024 were just like, hey, I need to buy a house. I need to move. Like, I can't wait until rates go down. They're not going to go down anytime soon. I think people were kind of waiting it out in 2023 to see if rates were going to go down. And when they didn't, they're like, well, my lifestyle is telling me I need to change my house for whatever reason. So people started moving. Sorry, people started, selling their houses more. And that's why we saw back to the peak in mid 2024. And the data for 2025, there's not really much on here, but I can tell you just from what I've been observing as an agent and what my brokerage has been observing, it's getting hot. Like the market is getting hot right now. Usually spring is always a hot time for sales, and it's getting crazy. Like houses are going for asking price or over, and they're going in the first weekend if they're priced right. So it's definitely, rates have come down like a half point since the new year. And that's really just that alone has seen people rush in. So I tell people when they say, will we see a correction? I can't. Nothing that I've seen data-wise or anecdotally is pointing to a correction. There are so many people trying to buy a house right now, but they can't afford to buy a house. Mostly millennials and first-time home buyers, they just can't afford to buy with rates so high. And so they are priced out of the market. As soon as rates go down, they will flood the market and be able to buy. So for all my investor clients who can afford to buy right now and can afford to pay a higher monthly mortgage for a year or two until they can refinance to a lower rate, now is the time to buy, because it's just going to get more expensive as soon as rates go down, and you'll be fighting with primary home buyers and everyone else that has been waiting for rates to go down. I bought a house in 2022, 2023, and 2024, despite the rates, because I got good prices on them. And that will not happen once rates go down. So I can only see prices going up for the foreseeable future, as long as rates stay the same or go down. Okay, there's a lot to unpack here. I'll go over it slowly. So I'm just going to put appreciation in real estate in perspective with the stock market as an investing method. So the S&P 500 has gained around 10% every year for the last 10 years. And the S&P right now is producing a dividend yield of around 1.5%. Most people don't even know that the S&P has a dividend, but they do. So if you think about it, this gain is the appreciation in real estate terms, and this is your cash flow. But people do not invest in the S&P 500 or the stock market oftentimes for their dividends. They are investing because they think the stock market will go up. And historically speaking, in the long term, the stock market has always gone up. So in my opinion, that is how you should be thinking about real estate. Because historically speaking, even if you bought at the peak of the market in 2007, 2008, before the largest housing crisis we've ever seen, you would still have made money, a lot of money on that purchase if you had bought at the peak of the market in 2007. So long-term, real estate always goes up, just like the stock market, and people are investing in the stock market not for the dividends, but for the appreciation. And you should think about that the same way for real estate. Now, assume you have $100,000 to invest. You put it in the stock market and you get a 10% gain, which is pretty bullish, honestly. So assuming you get, 10% gain consistently, you would make $10,000 that first year, and you get that 1.5% dividend. That's $1,500. So for a total of $11,500 in the first year based on that $100,000 investment. Now, take that same $100,000 and put it as a down payment on a $500,000 house. And assuming we can get a 5% appreciation in the first year, which is honestly pretty modest, in general, in looking back in history, you would get $25,000 in appreciation and 12% cash on cash, which is pretty realistic for a short-term rental in Colorado. You would get $12,000 in cash flow from that $100,000 investment into the property. So that is a total gain in year one of $31,000. And that does not include the principal pay down on the property that your guests and your tenants are paying your mortgage and they're paying down your mortgage. And doesn't include the tax benefits that are pretty crazy as well compared to stocks. So this is just a very simplified example of why real estate is really no-brainer to invest in if that's an option for you. Of course, you should be diversified. Like I have properties and I have stocks, so definitely recommend having a portfolio of investments, but this is just how real estate is such a better tool to gain long-term wealth at a much quicker rate than the stock market. Okay, another very big graph. I'll walk you through it. So let's start with the assumptions first. So assuming you buy a house as a primary, 5% down, and then you move out and you rent it. 6.5% interest rate, we're assuming 5% appreciation, which is again pretty modest, and you can get $3,000 a month in long-term rent, and we're assuming that rent will grow at 5% every year. So this light blue is your property value, and it appreciates over time. This dark blue is your principal pay down. So this is the amount of principal you are paying, or that your guests are paying every year. And as you get, further, you're paying less interest and more principal. And then this red/green is your cash flow. So the first year you're in the red because you had to pay the down payment, but you also had some influx as well. So you're not out the full down payment. And then as you go forward, your cash flow grows because the rents are appreciating as well. So if you sum all of this up, you get these 10-year totals. So your gross income, your gross rental revenue is $435,000, and that's before any expenses. Of that, your cash flow is just under $50,000, and your guests or tenants will have paid down your mortgage by $77,000. And the house will have appreciated at, again, a modest, realistic 5% appreciation. It will have appreciated by $314,000. So your total wealth growth in that 10 years is $440,000. That's on a $500,000 property. So your wealth growth in 10 years almost doubled, than of what you bought the asset for. And then look at the appreciation versus the cash flow. Appreciation is $314,000. Cash flow is $50,000. This is what people should be aiming for. Cash flow does not make you rich. Appreciation makes you rich in the long term. So whenever you underwrite a property, you should always be underwriting a conservative appreciation value as well, because that's really why you're investing in real estate. That's what's going to pay for your retirement. That's what's going to, pay for everything down the road. Okay, and these are the resources that I use to make this chart. So coloradorealtors.com is a really good resource. You don't need to be a realtor to access this. I really like this because it breaks out single-family homes and condos and townhomes into separate categories. So it's not, condos and townhomes aren't bringing the stats down. You can separate out. RE Colorado, which if any of you are on an MLS drip email from any agents. This is the website that does that. And they have a really good data analysis tool with it. It's kind of clunky, but anyone who uses this website should be able to figure it out. So if you are working with a realtor or me, happy to, send you information on a specific town or county or wherever you're looking. Or if you're not working with me, you can still ask me and I can run some numbers for you. Redfin has a lot of appreciation data. It's not necessarily valuable, and I'll show you what I mean by that. And then DMAR, the Denver Metro Association of Realtors, they have really good like aggregate trend infographics, that kind of thing. So it's a good like overview of the whole market. And I'm going to show you Redfin real quick. So this is a Silverthorne appreciation page in Redfin, and Redfin only reports monthly from what I've seen. If anyone else has like a better way to use Redfin for good data, let me know once I'm done. But this is their year-over-year growth. So year-over-year is like May 2024 compared to May 2023. And so it's saying the year-over-year growth from May 2024 has been 46%. Obviously, that's not realistic. That is just one point in time compared to another point in time. I like all of 2024 compared to all of 2023, because then you get a much better comparison that isn't sullied by really expensive homes being sold in that month. So yeah, like this is why I don't like Redfin for this reason. So just if you're using that, just be cognizant of that. But it does have other information you can definitely use, like days on market and homes sold and that kind of thing. So that's the tools I use. And then as far as like the stock market information, I just use Investopedia a lot as well. Okay, let's go next one. Okay, so for those of you who don't work with Good Neighbor, this is your first event, we have a lot of events like this about a ton of different educational topics. Webinars like this that are virtual. We have a lot of in-person events. If any of you live in the Denver area, we're also going to start having them in the foothills and the mountains this year too. We have a really awesome course. If any of you are new to short-term renting, we have this short-term rental pro course. It's $500, but if you buy a property with us, you get it for free. So definitely check that out. And then we do a lot of underwriting for properties. So any property that you're interested in purchasing, we can underwrite it for short-term rents, medium-term rents, long-term rents, house hacks. We're very good at underwriting what we think the property can make and what your cash flow would be. And then we have really comprehensive guides on how to sell your home, how you can get the most amount of money, all that stuff. And same with buying a property. We can go into a lot more detail about, where it makes sense to buy, but that's not what this property or what this podcast is about. And then we also have a podcast, B&B Financially Free, if you want to check it out. This is a QR code for the course if you wanted to check out more about that. And then what I didn't mention too, we have a lot of off-market properties at the moment. So if you are in the market for a property, whether you're working with Good Neighbor or not, please email me your buy box of what you're looking for. We're just coming out. We haven't emailed anyone about this yet, but we're launching 7, I think, off-market properties in Arvada and Westminster that are all turnkey. We have this one investor who's selling off a lot of his portfolio. So we have that coming. They're like 600 to 750 price point. I have an off-market property in Colorado Springs. That's a 9-bedroom duplex, like very unique investment. What else? We have a lot. So Mountains Metro, let me know what you're looking for. I can tell you if we have anything off market that would fit that. And then here's how you can get in touch if you are curious more about appreciation for whatever exact area you are looking at. Happy to do, more of a one-on-one sort of thing about that. If you are looking to buy an investment property or a primary residence or a house hack, We do all of it. We have thousands of clients all around Colorado that are doing short-term rentals. So we are really good at projecting what we can make because we have a lot of clients. We know their data. We can be very confident about, which areas make the most money depending on price points. If you're thinking of, 1031ing or selling your house, reach out about all of that. We do it all. So now's the time to sell and buy, really. Spring is definitely when most inventory is on the market. So really good time to start kind of figuring out next steps, and happy to chat through any of that. So I will stop rambling to myself at the moment and I'll open it up. Let me get back to the Zoom thing. Hold on, here it is. Okay. Cool. Let's Laura, where did you see that typo?
On your slide where you're comparing the stock market to the appreciation you get, you just added the two things together and said it was 31,000. I think it was even better. I think it was 37,000.
I don't know. But
It was the one with like two sentences comparing the stock market to the rental with appreciation and cash flow and dividends.
slide 7.
Anyway, it was just a comment if you wanted to update the slide for next time, because it was even better than you said, if I'm adding correctly.
This one? I'm not seeing it.
25 plus
This
12
one?
would be 30. No, that was the right one. Slide 7 was the right one.
Sorry, I don't know why people can't. Hold on.
I don't want to get you off track. It was just for your notes, but it was the slide you were just on before, that one.
I don't see it.
This slide right
Slide
before.
7.
The slide right before it that you were on. It's okay. Those last two numbers, the 25 and
Okay, are there
12
any
makes
other
37. Yeah.
questions, whether they're, you want to put them in the chat or raise your hand? I don't know if there's something wrong with the meeting settings that aren't letting people talk, but
Do you see it? 25,000 plus 12.
yeah, John, I see you're trying to talk, but I can't hear you. I don't know what's going on. But if you want to put in this chat.
Let's see.
Oh. Sorry, I can't hear everyone else. I don't know why. Oh, okay. Yeah, typo. Sorry about that. Yes. As underreporting gain. You're right. It's even better. And sorry, I don't know what. Here, I wonder. Okay. All right. Any other questions about anything? I'll send these slides out as well. Welcome. All right. Well, again, if anyone wants to talk to me, individually about their market, just reach out. My contact information is at the top of the chat, and happy to talk to anyone. So great. Have a good day, everyone.